today some of my most recent work on international monetary policy spillovers. And I am extremely glad to give this BBVA lecture. I think the motivation for this work is relatively broad. It has to do with understanding better the channels of monetary policy transmission internationally. I am an international macroeconomist. However, thinking about that, there are also issues about transmission of monetary policy period in a closed economy as well, which I think we still do not understand fully. Applied to the international setting, the international monetary transmission, transmission of monetary policy is particularly interesting, of course, because it has to do, or it is related traditionally to exchange rate regime, and in particular to the Mendelian trilemma, a concept I will describe again for you a little bit later. Recently, I have done quite a bit of work on something that I called the global financial cycle, which also I will describe in this lecture, giving you some stylized facts. And I think most of what I'm going to say is relevant for the possibly for the conduct and design of monetary policy and also of macroprudential policies, which have become very important after the crisis and with Basel III. So this is the menu for today, and in order to go through these points, so unfortunately I won't have time to discuss each of the findings maybe in a lot of details, but I'm going to be basing my talks on a series of papers. So the paper in which I introduced the global financial cycle, which is the Jackson Hole paper of 2013. I'm also going to be drawing quite a bit on my Mundell-Fleming lecture at the IMF of last year, as well as some joint work with Silvia Miranda Agrippino and with Evgenia Pazari, and some new work with Elena Gerko. Probably the two papers I will be citing the most are going to be the Mundell-Fleming lecture and the paper with Silvia today. Discussing these issues, of course, is a bit of a challenge because as soon as you talk about global financial cycle and transmission of monetary policy, you find out that there is actually a huge amount of literature, both on the econometric side for a number of things I'm going to do, dynamic factor models, monetary policy VARs in various dimensions, and then on the theoretical side with different models traditionally of monetary policy transmission, Mundell-Fleming, the new open economy macroeconomic literature, but also all the new models with capital market imperfections, which have become more and more prominent after the crisis. So there is a huge amount out there, and obviously I cannot give justice to all the literatures which are actually relevant for the type of issues that I'm discussing today. So in this lecture, I'm first going to show you some facts very briefly on the global financial cycles. So what is a global financial cycle? So as I said, introduced in my 2013 Jackson Hole paper, it's common movements in gross capital flows, credit growth, leverage around the world. It is also some remarkable, I guess, correlations between those co-movements and some indices of market fear, such as the VIX. And there's a couple of these indices around, but the VIX turns out to have a longer time series and shows remarkable correlations with a number of time series. I will show you that. So for example, if I look at gross capital flows, this is a chart taken from my 2013 paper. These are gross capital inflows across all asset classes. So you don't need to be able to read all these numbers. If you see green, it means they are positive. And these are correlations. And if you see red, it means they are negative. Okay, this is all that matters. And this is a huge matrix. And what is this matrix? Well, these are correlations of equity inflows into various geographical locations, FDI flows, debt flows, credit flows, so into North America, Latin America, Central Europe, Eastern Europe, Western Europe, emerging Asia, Asia, Africa, so various regions of the world. And you see that all these cells, more or less, are green, which means the correlations are positive. So there is a lot of co-movements in gross inflows across asset classes and across geographic areas around the world. So this is a first kind of fact here about this global financial cycle, the common movement in gross capital flows. Now, second one I'm just going to show briefly is if we look at an aggregate of banks, so World Bank's leverage growth, which is going to be the blue line here around the world. So I've just aggregated leverage growth of banks with some GDP weights. And I look at how these things co-moves with the VIX, which is the dotted line. And you see here again, we have some kind of negative co-movements with the VIX. So when the VIX goes up, so this index, which is the implicit volatility of the S&P 500, so often taken, as I said, as an index of risk aversion, uncertainty, there is a negative co-movement between leverage growth and the VIX. So more uncertainty, more risk aversion means less leverage. And by the way, these gross capital flows, it's also a stylized fact that if you look at the co-movements of these gross capital flows with the VIX, when the VIX spikes, again, more uncertainty, more risk aversion, you see fewer gross capital flows. So this is also a negative co-movement with the VIX here. Now, what I'm going to show you with a little bit more detail here is that if you look at a very broad cross-section of risky assets around the world, I'm talking about stock prices, I'm talking about some commodity indices and some corporate bond indices, what you find is that there is an important global factor which explains quite a bit of a variance of this huge panel of risky assets around the world. And so in order to show you that, I will show you that I estimate a dynamic factor model. As a direct follow-up on this, one may wonder whether this global financial cycle, these flows, this credit growth, this leverage, this global factor in risky asset prices is driven in any way by US monetary policy. And this is something that I will study using a large VAR here, a large Bayesian VAR. So this is the last kind of set of findings that I will show you. And in that Bayesian VARs, I will be able to look at the traditional monetary policy variables, but not only, I will also be able to look at all these interesting new financial variables, credit growth, leverage, risk premia, movement in VIX, global factor, and all that. So that's going to be the advantage of being able to run a big Bayesian VAR. So that's the menu, and I will end also by some various identification strategies for these VARs, and in particular I will also show you international monetary policy spillovers from the US to some specific countries, which probably you wouldn't have thought would be very much affected by US monetary policy, that is to say free-floating exchange rate countries with advanced economies, advanced financial markets, such as the UK, Sweden, Canada, and New Zealand. So that's the menu. After having seen this evidence on flows, on leverage very briefly, so let's have a look at this global factor in risky asset prices. So in order to estimate this factor, what we have done is to take this large panel of return of risky assets, as I said, stocks, corporate bonds, commodities, and we have fitted a dynamic factor model, so composed of a global factor, regional factors, and then some idiosyncratic components. So you can see it here in the specification. The return is going to be a function of a constant term, global factor, market-specific component, and idiosyncratic term. Obviously, then, we have to test for the number of factors and see how much of a variance is explained by this global factor, which is of interest to us. So in order to construct this panel, we take as long as possible a sample and as wide as possible a sample. That means we have two samples because a lot of emerging markets, unfortunately, start to have data series started in the 1990s. So the best of the two samples is the shortest one, from 1990 till 2013 sample. It's the broadest one in terms of geographic coverage. And to get a longer time series and to look at robustness, we take a longer but also a narrower sample which have mostly advanced economy. Now, when we test for the number of factors in that sample, so again, I'm not expecting you to be able to digest immediately all these numbers here, but all these numbers tell you is a test for the number of global factors and how much of a variance is explained by each of these factors. And so what all the test more or less say is that there is one global factor, and the variance explained by this factor depends on the two samples. On the narrower sample, it's a very high proportion of the variance by these two measures here, 2/3 more or less, or 60%. On the broader sample, it's 20 to 25%. Still quite a bit of a variance of these risky asset prices, which is explained by one global component. So here is the dynamic factor model that we are using. I already explained a little bit this setup. So now what I'm going to showing you is the structure of the factors. So we are allowing for, as I said, a number of factors. We test for the number of factors, and we find that one global factor is what the data is telling us. There is possibly some covariances across the factors, so we don't impose anything on the covariance matrix across the factors. And this is the idiosyncratic component for each of the returns. Now, here are the loadings. Each of these returns loads on the global factor. So that's by definition, that's what the global factor is. And then we have market-specific factors. They can be factors about the geography. They can be, we looked at factors about the sectoral composition. Can use different combinations there. And then you have the idiosyncratic terms. So that's the model that has been estimated. And here is what the global factor in these asset prices look like. So here we go. I think the most interesting one, as I said, because of the broader coverage of a sample, is the dark line here. This is the global factor with the shaded NBER recessions and the number of events that might explain some of the spikes on this factor. So we see in particular a very precipitous fall, that's Lehman Brothers, of course, in the time series. So very impressive fall at the time of the current financial crisis. Now, what is interesting about what this common component or this global common component looks like, maybe, is that again, and by the way, here everything is expressed in dollar, but it doesn't matter. If you express it in local currency, it will look more or less the same. What is interesting is that if we look at the correlation of this factor, which is the dark line again with the VIX, okay, which is the dotted line, that's the dotted line, that's the VIX, there is a very strong negative correlation. So we're talking about minus 0.8 or more here in terms of correlation. So again, there's a bit of a mirror image of this global component in asset prices and movement in the VIX. And by the way, I'm using the VIX again because it has the longest time series, but if you were to look at the V stocks, which would be the European equivalent, or the UK equivalent, or the Japanese equivalent, there is a huge amount, again, of common variations in these indices of volatility and risk aversion. Now, the correlation of a factor with other measures of risk premia, such as the Gilchrist and the Zakrajsek spread, is also high, but not as high as with the VIX. Or another measure of risk premium commonly used would be the BEA spread, the corporate bond spread. Now, in the paper, we have a very simple asset pricing model, and we use it to do a decomposition of a factor, this global factor, on realized volatility on the one hand and aggregate risk aversion as a residual on the other hand. So our global asset pricing factor just tells us that this common component should more or less be the product of the aggregate effective risk aversion of a market and then volatility of risky asset prices. So here we just project our global component on global realized variance, which looks like this. And we recover as a residual the aggregate risk aversion contained in our global price factor. And what you can see, I think, which is quite interesting, is that from 2003 more or less onward, you have this very strong decline in aggregate effective risk aversion in the market. And then we have, again, a spike, not exactly coincident, but again, at the time where volatility goes up, you have this spike in aggregate risk aversion, and then a little bit of a decline, but still at high level here. But you do see this very downward trend in risk aversion between 2003 and 2007. So that's the decomposition of a global factor. Now, the next step is to ask the question, or to see whether monetary policy in the center country of the international monetary system, that is to say the US, plays a role, if any, maybe it doesn't, in driving this global financial cycle, and whether there is any role for financial intermediaries in transmitting internationally US monetary policy. So this is the question I'm asking now. And why am I asking this question? Well, first of all, because I've done quite a bit of work also on the international dimensions of the US dollar, the importance of the dollar as an international currency. And so the dollar is at the center of the international monetary system. In particular, it's a very important currency in international banking. It's very important in financial intermediation. It's also an important currency in the international price system, as defined by Geeta Gopinath recently. So it seems like a natural question to ask whether US monetary policy has any role in driving this global financial cycle. Now, we do have some guidance regarding international transmission channels of monetary policy in the theoretical literature. And I'm just going to do a very brief review of what we know and what maybe we don't know about the possible channels of transmission. And then I will show you the result of this big VAR I've been talking about, of looking at the effect of US monetary policy on a number of variables, including my global factor. So here we go. So what do we know about international transmission channels? So first of all, we have a very traditional, mostly very much used and very useful model of Mundell-Fleming, where exchange rates and capital flows play a key role in terms of shaping how monetary policy spillovers may exist or not exist. And in particular, we have this very important statement about the Mendelian trilemma, which is the impossibility, you may remember, the impossibility of having at the same time free capital mobility, monetary autonomy, and a fixed exchange rate. Okay, so it's very clear that if you have a fixed exchange rate regime and free capital mobility, you are not going to get monetary autonomy. I think nobody is going to challenge that. It's very clear. Now, however, the corollary of the trilemma is to say that you can have monetary autonomy if you have free capital mobility and a flexible exchange rate. So in other words, the flexible exchange rate is enough to insulate you from international monetary policy spillovers. You can hit your domestic target in terms of monetary policy if you have a flexible exchange rate. So that's a very powerful statement of the trilemma, and this is this kind of view of the trilemma that I'm going to be challenging. If we look at open economy neo-Keynesian models, so here we have a very traditional trade-off between output gap stabilization and the terms of trade in this literature. And more or less, the bottom line of all the models in that literature is that if this is the relevant trade-off for international monetary policy transmission, there is not much spillovers quantitatively. So in a sense, that literature concludes that if everyone's house is in order, there's not much gains from international cooperation. In other words, spillovers are not very important. And this goes back, actually, so this is within these kind of neo-Keynesian, new open economy neo-Keynesian models. There's also an older literature, in particular by Ralph Bryant and a number of people, who have shown more or less the same thing using non-macro-funded model, but very much in the same spirit. So not much there in terms of gains from international cooperation, not much in terms of monetary policy spillover. So this is one set of models. Different set of models, which most of them have been developed in closed economy settings, are models with capital market imperfections. So in particular, models with some type of collateral constraint, net worth constraint, balance sheet constraint, something like that. Okay, so here we start. There's the so-called credit channel by Bernanke-Gertler, and a lot of recent work by, in particular, Gertler-Kayotaki, Gertler-Karadi, etc. Recently, we've seen some of these models in open economies. Farhi and Werning have worked on that. Aoki and co-authors also have worked on that. And there, so agency costs are important in those models. They can apply to banks or to non-banks. This literature started with actually collateral constraints on firms and households and not on financial intermediaries, but have been imported to the financial intermediation side. And there you can see that there is, so these agency costs result in some kind of wedge, an external finance premium. They're going to give you the cost of funds in some sense. And this external finance premium can be affected by monetary policy. So there is more scope for, quite a bit of action in terms of international spillovers. Even though it has not been developed very much yet in an international context, there is more going on. There are also, so this is one very important class of model, but another class of models which is emerging a little bit is also a model about the risk-taking channel of monetary policy. And here we go back to some description by Boryu and Zhu, and also Bruno and Shin. Here is the narrative of this model. So they differ a little bit by the way these models think about the constraints. Usually we are talking here about models with value at risk constraint, risk-neutral intermediaries. And the narrative goes in that way. In good times, asset prices are high, spreads are compressed, measured risk is very low. And so in good times, because you have a value at risk constraint, your value at risk constraint gets relaxed because of this low measured risk. And somehow this is going to lead to financial intermediary to borrow more. Asset prices are going to be even higher, and this simplifies the boom. So there's a kind of amplification mechanism also in this type of models. So this is one also existing literature. Now that may be very relevant as well, because what we do know from quite a long historical studies now about financial crisis is that credit booms are actually one of the best indicators of early warning indicators of financial crisis. We don't have very, very good indicators of financial crisis. There's quite a high noise to signal ratio, but credit booms is one of the best. The best, actually, probably right now the literature would argue. If the risk-taking channel is relevant, and if we see some international transmission via this channel, this can be also, this can lead potentially to big effects, okay? Unlike the neo-Keynesian literature, etc. So these are the type of international monetary spillovers that the current theoretical literature may suggest. So on the one hand, we have all these models with the credit channel, the balance sheet effects, which are going to work. In particular, so in the Aoki et al. Model is going to work through foreign debt on the balance sheet. We have the excessive risk-taking channel, which we just discussed. And we have also other types of spillovers via, so if we think about the neo-Keynesian literature, it may work through aggregate demand, externality as in Farhi and Werning, and incompleteness of market, or it may work through a pecuniary externality that would be more of the models with, again, collateral constraints. So these are the type of spillovers that may be or may not be relevant from the theoretical literature. So in all these cases, we are, in some sense, the Mendelian trilemma is going to fail because domestic monetary policy, even if you have a flexible exchange rate, will not be able to reach the optimum using only the interest rate. As the Mendelian trilemma will tell you, if you have your flexible exchange rate, you can reach the optimum with your interest rate. That's fine, you're fine. All these kind of spillovers are going to prevent you from doing that. There is no divine coincidence, so the floating exchange rate is not going to do everything for you. Now, let me qualify immediately. I'm not here saying, absolutely not, that floating exchange rates are irrelevant or useless. I'm just saying they are not enough to insulate your economy from international monetary spillovers. And so they are not enough to allow you to use your interest rate and hit your target. Okay. How bad the issues are will depend on which of these actual channels is actually relevant and how big the welfare losses are if you don't have any other tools than your interest rate, even with your flexible exchange rate, to achieve your optimum monetary policy. And this is to a large extent still an open question. So I'm trying to make progress on this question and I'm going to show you some evidence using this VAR to try to get precisely at these questions. What type of effects seem to be relevant? And this is in the hope to improve our theoretical modeling of these issues, to finally, in the end, address the quantitative importance of these international monetary spillovers. So I think this is a very important set of empirical issues and questions here. And in the end, it's about how we think we should model the transmission channel of monetary policy internationally, but that means also in closed economy, because I think there, again, the debate is not totally settled. Okay, so to back up my claims about, the dollar is important. So I told you that. It's important in the center of the international monetary system. It's important currency in international banking. It's at the heart of the international price system. So if we look at the data, it's kind of interesting to see that the dollar credit extended to non-financial borrowers, so even non-financial borrowers outside the US, is approximately 13% of non-US world GDP. That's very large, and that's even non-financial borrowers. The top 3 stocks of dollar credit are in 3 areas where you wouldn't think that much about them as dollarized area. Maybe you would think of China as a dollarized area, but you wouldn't think of euro area and UK as dollarized area. And yet we are in the top 3 in terms of stocks of dollar credit. This is according to BIS number, a study by Macaulay and co-author. As documented also by the BIS and by Shin in particular, there is a very important role for global banks, in particular European Union-based. In all this period between 2003 and 2008, we have seen a tiny bit the role of global banks in international capital flows going down since the crisis, and asset managers coming up. The dollar is also widely used around the world by asset managers, though we have less precise numbers at this point. But what we know is that the global asset management firms have more and more funds under management, and that again the dollar is one of the preferred currency in this industry. Now let's have a look at this cross-border and local positions in foreign currency. So this is only foreign currency by reporting banks of the BIS. And so what we see here is that this, the only currency which is very widely used abroad is this, as you can see, this big blue thing here, that's the dollar. You see some use of the euro as well, which is in green, but it's not nearly as big as dollar use on foreign markets. And then the rest is very small: sterling, Swiss franc, yen. We also see, by the way, that there has been a tremendous increase in this dollar use in all this period since 2000. And then we see some kind of level down a bit with the crisis. The stocks are still very high. So this is to motivate, this is just a few facts to motivate again why I'm looking at the effect of US monetary policy as a possible driver of the global financial cycle. Now, so how do we usually look at effects of monetary policy in macro? Well, we run VARs, and there has been very many monetary policy VARs being run. So I'm going to actually show you various ways of doing identification in this literature, etc. Most of the studies that have analyzed the links between US monetary policy and either some financial factor, which is a very recent thing to do, with a paper by Beckert here, or some recent work on between linking monetary policy and capital flows, have used small-scale VARs. So 5, 7 variables most of the time. And of course, this is because we cannot estimate a very large number of parameters if we use classical methods. That also means that there is always a concern about omitted variable bias in this small-scale VAR. And in particular, it has been quite salient in the monetary policy literature. The early work on VARs have shown that there were a number of puzzles coming up in small-scale VARs, price puzzles, price going in the other way that theory would predict. And it was typically dealt with by adding commodity price indices in order to span more information, to put more information in the VAR. So here, the way, I guess the innovation here in the work is that what we really want to do is, yes, to study the effect of US monetary policy on the standard economy, real economy variables, inflation, investment, GDP, etc., just to make sure that we are capturing what we think we are capturing. But also, we really want to include those financial variables and those global financial cycle variables. So that means we want to include credit growth, we want to include capital flows to banks, to non-banks. We want to include the global price factor, some measures of risk premium maybe. So we want to include leverage. So we want a lot of things. The way to do that is going to be to use Bayesian estimations by relying on some new work which has been done and that I will describe, and of course relying on some priors. Okay? And that's the way we can increase the number of variables that we can put in the VAR. Now the first set of results I'm going to show you, I will have two types of identification schemes. I will have, traditionally in the literature, what has been used are the Cholesky identification scheme with block ordering of variables into slow-moving and fast-moving ones. There are some issues when you look at financial variables, because you want financial variables to be able to react very quickly. And therefore, I'm also going to use a second identification scheme, which is going to be an instrumental scheme, effectively. And I'm going to use the Romer and Romer narrative approach as an instrument for US monetary policy shock. So that's going to be my first kind of set of results with these two different identification schemes. Fortunately, you will see that I will get very similar impulse responses. So that's going to be the good news. When I will move to more country-specific VARs, I'm also going to use completely different identification scheme, an identification scheme based on high-frequency data on Fed funds future surprises, which has been used by Gurkenak and co-author and by Gatler and Karadi recently. Okay, so I'm going to have 3 types of identification in my VARs. So here are, again, don't worry. I will show you big figures, and you will know what it is. But it's just to tell you, to give you the idea that there's a lot of variables in this VAR. And in particular, there's the whole top panel stuff is about real economy variables, so from GDP to disposable income, real private fixed investment, housing starts, and then you have the price indices, GDP deflator, consumption expenditure. And then all of that are about these financial variables. Global domestic credit, inflows, so credit flows to bank or to non-bank, various measures of US banking sector leverage, but also, remember we are looking at the international transmission here. So global banks, as I said, are important in terms of channeling dollar liquidity. So there's going to be also European Union, disaggregated actually also in UK and Euro area, banking sector leverage. I'm going to have also my global factor, the risk premium of Gilchrist and Zachak checks, etc. So a lot of financial variable as well. The setup of the VAR is a priori quite standard. So the only thing is that we are going to we are going to be able to add all these variables because we are going to use Bayesian estimation. And there we are relying on recent work by, in particular, De Mol, Giannone, and Reichlin, and Giannone, Lenza, and Premichieri, in order to choose the prior in an optimal way. So we completely build on their work there. So we import their technology. And so that it doesn't sound too mysterious, so what type of priors, what does it mean to use priors? Well, more or less, the type of thing that you are going to use for priors are very intuitive. So a lot of macro variables are very persistent. So you're going to start with random walk with drifts, allowing for co-integration. And then you are going to say, OK, you know, the lags which are recent lags have more information than distant lags. And lags on your own variables usually have more information than lags of cross variables, of other variables. So this is the type of priors that are used to do this estimation. And the tightness is optimally chosen. So what are the results? And I will show you, I will show you all the graphs, but I'm going to give you a little summary. So we look at 100 basis point increase in the effective Fed funds rate. What we are going to find are literally textbook results for the real economy variables. So if I want to teach the effect of monetary policy to my students, I can use those graphs because you have a negative effect on production, on inflation, whichever way you measure it, no price puzzle, on investment, on housing starts, employment. But interestingly, and this is the new part, we also have the effects on the financial variables. So what are these effects? So we have a negative effect on the global component of asset prices. We have an increase in risk premium, an increase in the volatility measured by the realized variance. We have a decrease in the bank leverage, both in the US and the European Union. And we have a decrease in global domestic credit with or without the US, and of cross-border credit to bank or to non-banks. So these are the variables that that are new to the analysis and that we find. Okay, so now in order for you to be able to read those graphs easily, so remember it's a 100 basis point increase in the effective federal fund rate, and responses are going to be expressed in percentage points. So that's going to be very easy to read. Now, you may not be able to see this, so I will blow them up. Okay, I will blow a few, but so to make sure that I'm not hiding anything, everything is here. Okay, we have done several baseline with from 22 to 25 variables. This is one of those baseline cases. I can pick up, for example, if we look at the real economy variable, you have a GDP variable here. That's the zero line. You see that we have a decline. No price puzzle. This is the GDP deflator. This is here. See that we see also a decline. And then we have all the financial variables, but these ones I'm going to show you bigger graphs. So here is what happens to global domestic credit, to cross-border credit to banks, and cross-border credit to non-banks. So you see a significant decline in all these credit measures. And these are in percentage points, so these numbers are quite big because we are talking about massive amounts here. So this is what we find for the credit variables. This is what we find for the financial price style variables. So we have, in particular, the global asset price factor here. So the decline. We have the excess bond premium, an increase. You have the volatility measured by the global realized variance. So you see the effect on these global financial cycle variables here. So here this is the measure of leverage which is based directly on the balance sheet of globally systematically important banks for the euro area and the UK. And in the US, this is US broker-dealer data from the flow of funds. So what we find, and so here the leverage responses are kind of interesting, I think, because what we tend to find is that the broker-dealers and the globally systematically important banks These are the banks which have important capital markets divisions. So we are talking about banks such as Société Générale, BNP Paribas, Barclays. These are in the list of systematically important banks. They tend to behave very similarly in terms of quick deleveraging and then bouncing back. Here, I mean, more or less significant, the bouncing back, but the quick deleverage is similar. There are fewer banks in the UK, so it's not as tightly estimated, but there is a kind of similar deleveraging which is reasonably quick. Now, if we take broader measures of leverage, with broader banking aggregates, with more banks, so not only the big guys, we tend to see the deleveraging later in the day. So there is a kind of difference in timing in this deleveraging. Now, we also do some additional exercise. You could wonder whether the decrease in global domestic credit is entirely driven by the US or not. And you could also wonder what happens to the monetary policies in the UK and also in the euro area as a response to what's happening in the US. So here are the answers to those questions. So here is the split between US domestic credit and global credit excluding the US. And you see that in both cases, this goes down, so the results are not driven only by the domestic credit in the US. This is the split between cross-border credit to banks and to non-banks. Again, a significant decrease. And here is again my deleveraging graphs together with what's happening with the euro area rate and the UK rate. And in both cases, you see an endogenous response. Now, it doesn't mean that necessarily at all that there is fear of floating or whatsoever. This is an endogenous response of the euro area rate and of the UK rate. You see some increase, but of course less than 1 to 1. Okay, so this is the endogenous response of the main central banks. So this was one set of results. So just to sum up, I've shown you very briefly some co-movements about the global financial cycle, then the estimation of the global component of risky asset prices, asked the question, could it be that US monetary policy is one of the drivers? There are several theoretical reasons to think about that, so, and the dollar is very important, so let's have a look. That was the Bayesian VER with a lot of variables. We do find there seems to be something going on in terms of US monetary policy and all these variables that are linked to the global financial cycle, including the global asset price factor, but also these credit flows, also these leverage variables in the UK, in the euro area. However, we want to be sure that we are not picking up some spurious things, and so we are doing the second identification scheme, which is using some instrumental variables instead of a Cholesky decomposition to identify our monetary policy shock. So the principle here is very simple, and again we build on the work of Mertens and Raven, recently also Gettler and Karady. And the idea is that you can instrument the monetary policy shock by some proxy variables and run the VER with this instrument. The conditions for identifications are very simple. If you have one shock of interest, it's the simplest case. Here we have only one shock, that's the monetary policy shock, which is of interest. So you need to make sure the instrument is correlated, it's strong enough, so you're going to have to do an F-stat as well. And that it's uncorrelated with the other variables. So these are the conditions for identification. We use here Romer and Romer narrative instruments. As I said, later on I will use high-frequency instruments. So this is the set of instruments we are using. I don't have time to go over the Romer and Romer methodology, but this is exactly what we are using here. Here are the narrative instruments for monetary policy. We extend the Romer and Romer sample to 2009, at which point the zero lower bound is hit. So we stop there. Here, again, don't worry. What you have to get from this picture is just that I've superimposed the two sets of impulse responses, the ones that I just showed you, and the one with these instrumental variable identification. And what you should get out of these graphs is that they are more or less the same. I mean, not exactly, of course, but they are more or less the same. All the stuff goes in the same way. The variable which is maybe the less well estimated in all these VAR, and which gets the more variation, is actually the exchange rate. So whether we use multilateral exchange rate measures or bilateral measures, this is a variable that gets the wider bands and does more different things between the two actually identification schemes. All the other variables that I have discussed give similar patterns. So this is, I'm just again showing you some, for example, here this is the domestic credit estimation for the US. This is the global credit estimation. So again, not exactly the same, but qualitatively it looks similar. This is the estimates for the excess bond premium, for the volatility, for the global asset price factor, for the term spread. So again, very similar. And this is the estimates for the leverage and for the interest rate responses. So again, this gives us some confidence. As I said, the exchange rate is not behaving very well, however. So what do we get from that? So one of the things I think we get from this exercise is that US monetary policy does seem to affect variables linked to the global financial cycles, does seem to affect this global factor in asset price, credit flows, leverage. So in part, the global financial cycle is driven by US monetary policy. Of course, this is not the only driver either, okay? And in the paper, you can find a variance decomposition of the whole variables. So for the global financial factor, I don't have the exact number in mind, but you will be able to see that depending on the horizon, you're going to be able to explain maybe between 2 and 10%. But of course, this is only about shocks, right? So as usual, the variance decomposition is not going to tell you anything about the systematic component. So it's not a small number to be able to explain between 2 to 10%. It explains quite a bit, actually, up to something like 15% of the credit flows. So this is not the whole story by any means, but it seems to be there. Now, does it matter? Well, what does it tell us? Well, what fundamentally that it tells us is that all these countries are importing financial conditions that may not be correlated with their cycle, with their economic cycle. So if everybody was perfectly correlated and US monetary policy is kind of has spillovers, then it doesn't really matter. But if you are different economic cycles or different financial cycles and you import, and these spillovers are important, then this may matter if we believe in some of these transmission channels, either via pecuniary externality or financial stability channels, these balance sheet channels. This is where the models will be very important. And this is where we need to sort out how big potentially these effects are from the point of view of welfare. So it is possible that countries import monetary and financial conditions, even conditions leading to asset price bubble, which are not appropriate for their current financial cycle. So it is possible that these spillovers affect financial stability. Now, you could say, you've done this big VAR, US versus rest of the world, global financial cycle, etc. But maybe most of these results are actually driven by fixed exchange rate regimes or semi-fixed exchange rate regime, for which we know that there is no independent monetary policy. Right? Nobody challenges that. So it's worth digging further and take specific examples of countries for which we think are typical example of inflation targeters, free floaters, with advanced economies, with a lot of developed financial markets, and to see whether we find anything for this set of countries. So really to take one extreme of the distribution. And so this is why I'm now investigating whether there is financial spillovers or not in New Zealand, Sweden, Canada, the UK. I could do more, but just a question of finding the data. And there I'm using yet this other identification scheme, okay, again for more robustness, and this is surprise in Fed funds future prices in 30 minutes windows around monetary policy announcement, around FOMC meetings. So this is exactly the identification schemes that have been used in the literature by Gerkenak and by Gettler and Karady. And I'm using these shocks to instrument, again, for some measure of monetary policy, either the Fed funds or the 1 year, or you could instrument different measure. Of course, you have to test for the strength of the instrument for each of these instruments I've been using, and this depends on the variables you have in the VAR. Okay, so you always have to check the validity of the instrument. Now, so the first result in order to get an idea of the magnitudes is to use this identification scheme on the US itself. And here it's more or less replicating the results of Gettler-Karady, except using also the VIX in the VER as an indication of one of the global financial cycle variables. So here what do we see? We see that if we have a 20 basis point increase in the US 1 year, we see what we expect to see on CPI and industrial production. We see an increase in VIX. And what we see, so here are two measures of the external financial premium. One is based on mortgage spread, and one is based on the commercial paper spread. And I'm going to use mostly mortgage spread because the data has been more widely available in my cross-section of countries. So I'm going to compare the magnitude of a response of mortgage spread of US monetary policy on US mortgage spreads, and I'm going to do the same thing for this set of countries that I just discussed. So you see here that the response of a mortgage spread is approximately, the point estimate is probably around 7-8 basis points, okay, for a 20 basis points increase in the US 1 year. So that's the order of magnitude for this channel of monetary policy transmission for the US. Now let's have a look. What do we find for Canada? Well, if we look at Canada, so interestingly, what we find is there's an endogenous response of policy rates, the policy rate in Canada. And what we find is the mortgage spread in Canada raises by about 9 basis points. Also following a US monetary policy shock. So here again, I'm not looking at Canadian monetary policy, I'm looking at the US monetary policy again instrumented by these high frequency instrument. F-stat above 10, so this instrument is valid. What about Sweden? Effect is a bit more muted. You do see an effect on the mortgage spread, but it's of a smaller magnitude, maybe 4 basis points, 5 basis points on impact. What about New Zealand? So here, it's quarterly data, because unfortunately, New Zealand doesn't have monthly data for some of these time series, so to change the setup here. It's a 40 basis point increase, so it's a double the shock. And it's here you have maybe a 15 basis points effect or something like that, but so you have to divide by 2. So it's about, again, maybe 7 basis points. Response of the UK. So interestingly, the UK, again, you see an effect here, and it's a relatively strong effect. So the peak of a response is about 12 basis points. For the mortgage spreads in the UK. I mean, there's no doubt that, I've run quite a few of these VARs, but one can run more, that's no question. But at least the current state of play seems to suggest that these responses are roughly of the same order of magnitude than the domestic US responses to US monetary policy shock. So these responses on the mortgage spreads, which is, one of these measures of the external finance premium. Even though all these countries are free floaters. So how big that is it a big number to have, 4 basis points, 10 basis points? Well, it depends a bit of what you think whether the US number is already big or not. So if you think this channel is irrelevant in the US, then it's not very relevant either internationally. If you think it's a big deal in the US, which I think we still don't, this is the type of thing we still have to ask ourselves, then internationally, at least it seems we get the same type of order of magnitudes. So then we should not discount that. But now, is it a big deal or not? That's really the important question that I can't, at this stage, really answer. Okay, and I need a model for that. However, what this type of exercise, to my mind, clearly shows is that Whenever we want to test for monetary policy independence, if we run only regressions on correlation of short-term rates, which has been one of the favorite tests of the Mendelian trilemma, then we cannot get the right answer because the short-term interest rate is not the sufficient statistics in order to discuss monetary policy independence. And we have seen that some of these countries were actually responding, some were not. So the short-term interest rate does different things. And yes, yet we have some spillovers through this external financial premium. There are more questions maybe than answers, as usual in this type of research agenda. What we can say is that US monetary policy is one of the drivers of credit growth, certainly in the US, but also abroad, of cross-border credit flows, of leverage of US banks, but also of the European banks, that it is a driver of a global factor in asset prices and of mortgage spreads, including in free-floating countries, such as Canada, Sweden, UK, New Zealand. Now, it doesn't mean, so everything that I said is kind of independent of the very interesting literature by Calvo and Reinhardt on the fear of floating. So these authors have argued that very often, actually, central bankers say they are floating, but they are not really floating because they are afraid of the exchange rate appreciation, so they actually do something to mitigate that. Obviously, if you do something to mitigate that, then you lose some monetary policy independence. Now, I'm not saying this does not exist. The two things may actually reinforce each other. But these channels of transmission, these spillovers I have been discussing, are distinct from the fear of floating. Of course, so these two channels may kind of definitely reinforce each other. There's no issue about that. Now, I think the very big question we have to answer is, given this set of empirical evidence, which of these models do we favor in terms of transmission of monetary policy, both internationally, but I guess also domestically? And based on that, are these type of estimates a big deal or not? So how big an issue is it that, in a way, the trilemma is failing, that even with floating exchange rates, you cannot reach your optimum domestic target using your interest rate? So if this international credit or risk-taking channel or both are really potent, then what it points to is that you cannot reach this optimum with your one domestic instruments, and this is where macroprudential policies come in potentially to restore some monetary autonomy. So you have several issues to deal with, you need several tools, and the interest rate is one, and then you need to introduce these macroprudential ones. So I do think that in order to assess how important macroprudential policies are and how best to do them, we have to settle what type of models we actually want to work with. And I think this is where we are now, and that's quite an exciting research agenda, but I don't know the answer yet. And I'm very happy to take questions. I think we have 10 minutes left. Chair? Yes. So if you have any questions, I'll be happy. Yes, please.
Hi, I really enjoyed this talk. Obviously, my question is going to come more of what you said at the end and at the beginning, which I had some questions. But the Canada, Sweden, US, New Zealand example, I'd like to ask you what you really think it shows. Because if the US is responding to something that's global, that's also affecting these countries, wouldn't you expect some common code movement in the short-term policy rates of these countries? And I guess the other thing I would say, and more related to the first part of your talk, which is when you have this global factor in asset prices, how big is big? I mean, if there's a global cap-M kind of thing going on here, are those 20% or 60% global factors, are they large numbers or not? So if you could say something about that.
Sure. The first question. So the identification is precisely supposed to take you the unexpected component. So what I'm picking up here is everything that is uncorrelated with all these variables that may be describing what is going on in the world, And I have quite a few of those because I also have very different, as you've seen, identification schemes. And so there, this is really an expected component of a monetary policy shock in the US. And I'm looking at what it does, well, in the US or what it does on these countries. So if we believe identification, the exogeneity of instruments, then we should take care of that. On the second question, so how big is big? I think that's precisely, that's a very good question, because in a way that's asking for the global financial factor exactly what also I've been asking at the end about, is it a big deal or not? The only way to answer this question is to have a model. How big is big? I can only give you the statistical answer about the variance decompositions, about etc. And whether it really matters or not, in the end, really will boil down to the type of model we are going to be writing to fit those facts, and then what type of welfare implications we are going to be getting from these models. And this is the part of, I guess, of the research agenda which is still missing. So. We can start with very different priors. So some people may think that indeed the world is very integrated, and this is no big deal if there is a lot of co-movements in all these things. This is reflecting some shocks and in an optimal way, some portfolio rebalancing mechanism that is going to equate returns or induce capital flows in a way that doesn't necessarily affect welfare in any significant way. Everything is optimal. Now, if you have a model in which there are these, for example, financial stability concerns, so if you have a model which allows for some frictions in capital markets, and you start seeing countries which are in a boom and still importing via some kind of either risk-taking externality or something like that, this kind of financial conditions in the US that are very loose, and induce even more risk-taking at a time where your economy is already booming, then you may think that you might have serious welfare consequences because financial stability may become a serious threat. Okay, so you might think, booming economy, importing an asset price bubble on top of the current economic conditions may not be a good idea, and we'll end up in a financial crisis. And you may interpret maybe some of the evidence during that last crisis in this light. But I don't know. This may not be the right model. We really, that's where the work. I think it's a very open debate. But coming one side or the other has kind of very important consequences.
Basically one comment and one question. And the comment is more about semantics. I think what you show quite convincingly is that there are these financial spillovers from monetary policy and maybe from other shocks, and that creates potentially trade-offs between financial stability and price stability. And as a result, if monetary policy also cares about financial stability, it may not affect price stability. And so that's where having another tool comes in as a sort of an optimal, to get sort of the overall optimal. It doesn't mean you've lost your autonomy in terms of monetary policy, because in principle you can still, in most of these models, you could still focus your monetary policy instrument on the price stability objective. It will come at a cost in terms of financial stability, but that's a policy choice. No? So again, it's more semantics than anything. The question is more the big question about what do you think your results mean for the international financial system and its and international financial policy and cooperation. Mm-hmm. I'm not sure these results, because of course you're looking at, you identify a particular thing to see whether these spillovers are there. But I guess for that you would have to basically know better what are the underlying sources of this financial cycle.
Yeah. So on the first comment, so I would almost agree with you, but not quite, because in the sense that it is absolutely true that if the issue is going to be financial stability, so we are going to be talking more about and should monetary policy care about it or not. So first of all, then there's an issue of mandate and trade-offs between the two, but maybe the mandate of monetary policy is more squarely linked to inflation, and you can think of macroprudential policy more about financial stability. But I can also, and so that would be your kind of comment. And but of course. There are two problems with that. So one could be that in a dynamic sense, financial stability is also going to matter for your traditional monetary policy variable. So your inflation rate, your output, your level of economic activity, etc. So even if you cared only about these variables, but in a forward-looking way, it might affect your conduct monetary policy.
My point would be that this is true for national factors affecting financial stability too. So it's international.
Yes, but the bit that is maybe more international in nature is that you can probably, think of models in which when you have a dollarization of a balance sheet, actually even if you don't care about these kind of financial stability issues necessarily, you are going to have much more trouble to hit your domestic target in terms of input, in terms of output inflation trade-offs because of this dollarization. And so your interest rate, again, is not going to be enough there because you're going to have these issues with how you deal with dollarization of your balance sheet. I think if you want a current kind of model in progress about that, the Aoki model is a good one. So it does affect directly your ability to actually hit your target.
I think in Aoki, if you want, you can always hit.
No, you can't.
Flexible exchange?
No, you can't. Yeah, but that's precisely one of the issues. But it may not be the right model. But one can see that there are issues like that are going to come up when you start having dollarization. So that's one thing. And the second thing is, what does it mean to for the international financial system? So we really need these structural models for that. If we take these things seriously, if we really think there are issues, then we always talk about international monetary cooperation in the sense of central banks talking with each other, too much liquidity, too little liquidity. But we could also talk a lot more about cooperation in macroprudential policies. Depending where the imperfection lies, you might think that actually some macroprudential policies have to be set by the recipient countries, and some have to be set by the countries that send actually capital flows as well. And having here a little bit more cooperation and thinking could be one way forward. The way this will look in terms of optimal policy tools will entirely depend on the friction. So this is where we need to make the progress. But I can see that there's going to be some more fruitful cooperation on the macroprudential side, maybe even than traditionally on the global liquidity side, potentially.
I'd like to follow on the previous comment about monetary policy independence. Well, if you ask Central Bank of Canada or New Zealand, they will say we're successful inflation targeters, so we hit the target. So and I guess it's well understood by central banks that they can affect short-term interest rates, but when it comes to longer maturity, if you're looking at mortgage rates and asset prices, ability to affect those limited, and everything is driven by global capital markets. So I'm not kind of sure what kind of new you bring to this kind of knowledge of monetary policy, conduct of monetary policy in those small countries.
So again, I think the issue is going to be whether these transmission channels that you get through financial spreads, so how big an issue are they for your economy? So if your mortgage market is going to be affected in a way that down the road will lead to a crisis, again, you might think that you want to use additional tools. So macroprudential tools are going to be the ones probably that you're going to be thinking of using. But certainly you're not going to be able to say that having a floating exchange rate is able to insulate you and conducting your inflation target business as usual is going to deal with that issue. So we go back to the problem of what are the financial market imperfections and how threatening are they for either financial stability or in some extreme cases, maybe how threatening are they for even hitting your target. It might not be the case for each country because it might depend on the degree of dollarization or whatever, or typical structure of balance sheets, but for some countries it might be the case.
I wonder whether you could comment on capital controls. So some of the emerging markets have imposed capital controls on inflows to insulate their ability to conduct independent monetary policy. How successful have they been?
Yes, so there is again a very wide debate on capital controls. So and there are a lot of studies also at the IMF around these issues these days. So here I think my view is more like if you identify exactly where the problem is or where the imperfection is, you're probably going to get more targeted instruments than broad-based capital controls to deal with it. And so it's going to be better to use targeted macroprudential tools to kind of deal with, for example, too much inflows in a specific financial asset or something like that. And there are countries which have experimented with such tools, such as South Korea, both quantitative and also taxes, actually imposed at the same time. So whether they have been useful or not, again, opinions might diverge, but some people say they have actually worked. I think we need longer time series to be a bit more affirmative about that. Capital controls might be used if you don't have the availability of those macroprudential tools for institutional reasons, or if you really cannot get them to be effective. You might try to deal more with market-based finance using capital controls because they are going to be broader than tools which are geared only at the banking system. I think it's a very idiosyncratic thing, all that I'm saying here. It has to depend so much on the institutional setup, on the supervisors, etc. But I'm very reluctant to give very, broad-based answers to this question. I think we really need those longer time series and assess what has been done and learn from that.
I wonder if you use this model from developing countries, for example, from Turkey, probably, do you expect to reach the same results?
Well, so on the Turkish economy, it would be very interesting to do, actually. I would expect to find quite strong results for Turkey because it seems to me there are lots of transmission channels with a lot of dollarization as well in the Turkish economy. And I'm not sure I would have to look precisely at the central bank policies in terms of fear of floating issues and stuff like that, but my feeling is that there would be quite a lot in terms of... there's actually a nice paper by Şebnem Kalemli-Özkan, trying to look at similar issues, but with very detailed firm-based data, so very granular data, and seemingly finding some evidence of quite a bit of risk-taking being driven by US monetary policy. But it's being, I think it's work still in progress, so we'll have to see, but it seems to point towards the same type of effect.
One of your main conclusions is the impact of US monetary policy shock on global asset prices. Can you also try to study the impact of monetary policy shocks from other countries to validate your statement?
So to look at other central banks?
Yes.
No, so I would love to do, I'm sure there must be some effect by the ECB, for example, but maybe even the Bank of England, but so far I haven't managed to do that yet. My strong prior is that the US is going to be the strongest because of all the things I've said about the importance of the dollar in the international monetary system. But I would be surprised if I find nothing at all for the ECB and the UK. I just haven't done it. And the problem is you need long time series for a lot of these things. And as we know, the ECB is a relatively new comer. Thank you very much.